listening to the Vault Podcast, bringing you diverse perspectives about 4IR innovations and the law, and providing a space for challenging the future of legal tech. These are the voices of law and technology. This is Vault.
Welcome to the Vault Podcast. I am Nerushka Bowan and will be one of your hosts. On today's episode, we will be talking about decentralized finance, what it is, how it works, and its potential future in the financial ecosystem. This was recorded as a live Clubhouse session, moderated by myself and joining Dean Joffe and Ashlin Perumall. Without further ado, on to the conversation. Hi everybody and welcome to the Vault Law Tech Room on Clubhouse. Today we're discussing demystifying DeFi. For the listeners, I'd just like everybody to know that this is being recorded for the Vault podcast. So the topic today is called Demystifying DeFi. Your speakers tonight are techies with a legal background who've worked in tech law, privacy law, and fintech law. And we'll be breaking down some of the technical terms for a non-technical audience, as well as discussing some of the legal and regulatory implications of this mystical world of DeFi. So let's start at the beginning and understand what the terminology means. What does DeFi mean? And what does the term DeFi actually stand for? So Ashlin, if you could give us a simple explanation to kick off.
Thanks so much, Nerushka. It feels like just when we, the average consumer, managed to start getting to grips with concepts such as distributed ledgers and blockchain, the industry decided to throw us another humdinger. And even those experienced in the field might be finding themselves a little bit out of depth when looking at DeFi, because it's a new phenomenon. It's something that is still in its infancy days and something that we need to understand. So hopefully we can give you a basic description and compare it to some things that are useful as metaphors to understand the area. The best way that I always find to think about DeFi is to firstly look at the one of the features of the cryptocurrency and DLT arena, and that is decentralization. Currently, a major feature of cryptocurrencies and tokenized assets is the ability to have a decentralized platform be the backbone of how they operate. But currently, most of these decentralized platforms focus on a means of conducting payments or simple transactions. So if you look at Bitcoin, for example, the main purpose of Bitcoin is to either be a form of payment or a store of value. And this is true for quite a number of other cryptocurrencies. But the question is, when it comes to money, the only use we have for money is not just payments. Money also is used for financial services. There's a whole ecosystem of financial services built around money. For example, there's lending or borrowing. If you want to buy a house, you would have you'd go to your bank for a mortgage, fill out a couple of forms, show that you have a good credit rating, and get a mortgage. For example, if you wanted to do savings or have some sort of interest accrual, you might take out a fixed deposit. And if you've bought a house or bought a car, you might want to take out insurance on that particular asset. So there's a whole bouquet of financial services that exist around money, in addition to its function as a means of payment. So the purpose of DeFi, and to break out the acronym, DeFi stands for Decentralized Finance, is to bring the decentralized benefits of distributed ledger technology such as blockchain to financial services. And there's a couple of benefits that you get from doing that. One is obviously the removal of some sort of centralized authority that is creating the platform for financial services. So that reduces the risk of, for example, corruption and fraud. It also reduces intrusion. So for platforms which want to have a lot of freedom in respect of how they conduct their financial services, it removes that centralized platform or arbiter, which also enables open accessibility to those who would not typically have been able to enter these financial ecosystems. In addition to that, centralized governance also depends on the people enacting it. And one of the main features of decentralized finance, as we'll see, is that it's not based on people, but rather on code and specific protocols designed into the code. And then there's also a reduced risk of manipulation. So those are the benefits that you would have over above centralized finance with DeFi. The main difference I would look at to compare this to current centralized finance that we're used to is that with centralized finance, you're trusting the company or the people sitting behind that particular financial service. Whereas with decentralized finance, you're not trusting people, you're trusting protocols and codes, and that they will work in a particular way. Now that's a little bit of a description of how DeFi fits into our world. I thought I'd just quickly spend some time on the structure of DeFi and how that actually can be defined in a way that makes sense. One of the main requirements for decentralized architecture is some sort of infrastructure, right? Some sort of system, programmability, platform, or something in which you can actually embed these protocols. What you will see in the industry is the Ethereum protocol has been one that has been most popular for this because of its robust abilities to create decentralized applications or dApps. And that's tick number one. You need for DeFi to have some kind of decentralized platform that allows you to create these products in the form of programmable smart contracts. The second thing that you need for DeFi is some sort of stable base of value. Now, for those of us who are familiar with the cryptocurrency world, one of the unfortunate features and perhaps one of the reasons why the utility of cryptocurrency has struggled a bit is the volatility. It is very hard to build financial services when the bedrock is extremely volatile. So you will see with a lot of DeFi systems that, and for example, make a DAO, which we'll talk about in a second, which is a popular DeFi platform, they look at creating stable coins as their base, and that allows for stability in respect of the fluctuations of the value of the underlying decentralized finance system, and that allows you to build interesting things on top of it because of that stability. Now, once you've got that, you can then start building different types of decentralized financial services. And these aren't uniform. There's a variety of them, and we'll talk more about them as we go on the conversation. Examples are decentralized exchanges, systems for lending and making money and interest off of your cryptocurrencies, and then the ability to build and chunk these together in a way that's useful to you. So one of the really, really cool features of all of these decentralized DeFi services is that most of them are being built with some degree of interoperability. And that means you can basically package your service or DeFi financial service in the way you want to do it. A term that's been used to describe this is DeFi Lego. And these DeFi services can be chunked together to achieve what you, the user, want to as your own particular goal, kind of like software libraries. An example of that could be you could chunk together different DeFi services to borrow money. For example, if you've got Ethereum, you can use that to borrow DAI on the MakerDAO system. You can then use a different financial service, DeFi financial service, to then use that DAI to lend that out. And then you can use another service to insure against the risk that's associated with that lending. So there's the ability of really build your own product in the DeFi world, which is really, really exciting.
Great. Thanks so much for that explanation. And just to understand again, at the beginning you said money is not just for payments. There's an entire ecosystem of financial services built around money. Is it correct to say cryptocurrency is not just for payments? DeFi opens up an entire ecosystem of financial services built around cryptocurrencies. Would you say that's a good analogy?
I would think so. I think what DeFi does is it takes cryptocurrencies and allows them to be used in the way that we are used to using money. So I definitely think that's an accurate statement. The catch to that statement is that that's the theoretical goal. Whether we've achieved that yet or not in current DeFi platforms is a big question mark.
Great, thanks for that. Dean, if you could perhaps give us your explanation of DeFi and anything to add to Ashlin's explanation, and then if you could also tell us where did DeFi actually start, and give us a little bit of context and background as to the beginning and where we are now.
Absolutely, and I think Ashlin has really summed up nicely what is DeFi. And to give my different perspective, although similar, is that, as mentioned, DeFi is short for decentralized finance. And it's the notion of recreating traditional finance in a decentralized architecture outside of companies and governments' control. So in essence, what we're doing is it's a form of finance that doesn't rely on the central financial intermediaries such as brokers, exchange, or banks to offer traditional financial instruments. And it instead utilizes smart contracts on blockchain, and the most common of this being Ethereum. Now, what DeFi platforms allow people to do is, for example, lend or borrow funds from others, speculate on price movements on a range of assets using derivatives. They can trade cryptocurrencies, they can insure against risk, and they can earn interest in like savings-like accounts. Now, if we take it back in time, it is arguable that DeFi started with DAI, which is the one-to-one backed with the US dollar cryptocurrency. And it's considered the first example of decentralized finance to receive significant adoption. Now, DAI is created to form like an over-collateralized loan, and the repayment processes are facilitated by the MakerDAO's smart contracts in the form of a decentralized application. So users who deposit Ethereum or other cryptocurrencies accept this as collateral, and they're able to borrow against the value of their deposits and receive newly generated DAI. So if the value of the collateral declines below the ratio, then the loan can automatically be liquidated by smart contracts. And conversely, on the other hand, if its value increases, additional DAI can be borrowed. So when we look at DeFi and the context behind it, in essence, all it is, it's trying to recreate the financial system in a decentralized manner.
Thanks, Dean. Now, you talked a lot about decentralization, not having these intermediaries to kind of regulate what's going on. Everything is based on the code, whether you need to go up or down. Now, what I want to understand is in the event of a dispute, what happens then? Is the code so bulletproof that there will never be a mistake? I mean, after all, there are humans that are actually using these products, and we know humans do make mistakes. So how does DeFi deal with things when things go wrong?
So I think that one way to think about that is there's probably a couple of areas which you need to consider in respect of the human potential for creating risk in DeFi. The first one, which is the most immediate one, and the one that probably needs to get fixed the soonest, and that is the risk of incorrect or problematic programming in the smart contracts. And that's because of the risk of major transactions happening and a single glitch in the system causing unintentional or even intentional harm in respect of malicious actors. So at the first layer, better systems for controlling smart contract code is something that is still being investigated, and there's still risks existing in current platforms which need to be overcome. In addition to that, there are the governance risks associated with many of these platforms, and that is because of their very nature that they're decentralized. They are regulated and governed by governance of the users. And in this case, MakerDAO, as an example, has specific tokens which are used for governance. They're called the MKR tokens. And holders of the MKR tokens can do a variety of things to the actual underlying protocol that's associated with that particular DeFi platform. For example, a governance token holder can add new collateral asset types in accordance with unique risk parameters. They could modify the DAI savings rate. They could choose specific Oracle feeds, and they could trigger emergency shutdowns, for example, or even upgrade the system. Now, that's another entry point for people to start influencing the protocols behind the system. So to some extent, a lot of platforms are making a lot of effort to ensure that these human actors behave in a way that is very restricted. But there is going to be a need for better standardization and education of consumers so that they can understand what these risks are and how they affect these platforms.
Thanks, Dean. Anything to add to that?
I don't think anything to add. What I would definitely emphasize is that, if we look at a practical example, DAO is maintained and regulated by the MakerDAO. So that's a decentralized autonomous organization, which is composed of the owners of its governance token, as Ashlin mentioned, the MKR. And these people who hold the tokens vote on the changes and set certain parameters in the smart contracts in order to ensure the stability. So this is quite a fundamental element of this, and it's something that organizations are continuing and continue trying to evolve in order to have the best governance framework.
How would I become a holder of one of these governance tokens? Is there some kind of vetting process for a governance holder, or is it whoever has enough money to purchase one? What does that process look like?
So I think just to touch on your point, in essence, you can go and buy various DeFi tokens, which are available on different exchanges. And once you hold these different tokens, you may have certain rights as a result of holding these tokens.
Cool. Thanks for clarifying that. So, we've spoken a little bit about the background of DeFi, the kind of meaning of the word. But if we could get a little bit more technical for a minute, under the hood, how does DeFi actually work? How would I participate in the ecosystem? Could you give us a little bit more detail on that side?
Absolutely. So in essence, DeFi revolves around the applications known as decentralized applications, or dApps, that perform financial functions on digital ledgers called blockchain. And that's a technology which was ultimately first utilized by Bitcoin and has since been used in a much broader context. So rather than transactions being made with and through a centralized intermediary, such as a cryptocurrency exchange, where they are centralized, transactions are directly made between the participants, and these are governed by the various smart contracts. So decentralized applications are typically accessed through enabled web browser extensions or applications, and these allow the users to directly interact with the Ethereum blockchain through specific sites. And many of these decentralized applications can connect and work together to create complex financial services. So, for example, stablecoin holders can commit assets to a liquidity pool. Others can borrow from this pool by contributing additional collateral. And typically, this is more than the amount of the loan. And what the protocol automatically does is it adjusts the interest rates based on the moment-to-moment demand for the asset. Now, if we take it into a more practical example, a common DeFi protocol is something known as Uniswap, which is a decentralized exchange that runs on the Ethereum blockchain and allows for the trading of hundreds of different digital tokens that are issued on the Ethereum blockchain. So rather than relying on a centralized market maker to fill order, Uniswap's algorithm incentivizes users to form liquidity pools for the tokens by issuing trading fees to those providing liquidity. So a development team will write the software for deployment on Uniswap. And in essence, what will happen is the platform will ultimately be governed by its users. So because there's no central party that runs Uniswap, there's no need to check the identities of these people using the platform. And therefore, it is not clear what position ultimately regulators would take in the future. But that is how the DeFi is actually working on in the background.
Just to elaborate on the point that you made with regards to it's not clear the position regulators would take. In South Africa, for example, we have the Intergovernmental FinTech Working Group, which is the group of FinTech regulators or financial services regulators who have come together to look at innovations in FinTech and specifically cryptocurrency or crypto assets. They have published policy papers on this point. And if you read those policy papers, it is quite clear that they're seeking to regulate the on-ramps and off-ramps into and out of crypto, the intermediaries, the exchanges, the wallet providers, the payment providers, those type of players in the ecosystem. Now, it seems like, from what I'm hearing, DeFi is definitely throwing a spanner in the works based on the policy considerations that have already been taken. There's a definition of something called a crypto asset service provider, and it's really this category of people that will carry bulk of these regulations by the regulators. Now, from what you've seen, is it possible to even attempt to regulate these type of DeFi setups? And if yes, is the current policy decisions the way regulators are going? Is that the correct way? Or do you think policy needs to already be adjusted to make room for DeFi?
So I think let's break it up into 2 points and take it back a step to give a bit more context. So the first is in respect of the proposed regulations by the Intergovernmental FinTech Working Group, and the second is how do we regulate? So to give everyone a bit of background, the Intergovernmental FinTech Working Group was set up, I think, in 2016 or 17, with a aim of looking at various cryptocurrencies, which is what it was called at the time, and methods on how to regulate cryptocurrencies. And one of the key mandates was, how does South Africa adopt regulations that do not stifle innovation? So that's what we saw a couple of years ago. And it became very prevalent after what was considered the 2017 bubble, where a lot of consumers lost some funds, and there became this need to regulate cryptocurrencies. What resulted in 2020 was the Intergovernmental FinTech Working Group proposing, I think it was 10 recommendations. And as part of these recommendations, they proposed regulating crypto asset service providers. Now, what that means is that crypto asset service providers would have to register with a regulatory body, and they would have to conduct certain activities such as AML KYC requirements, which would require them to onboard their clients through what is considered the FICA process, and ultimately know the identity of the underlying clients. Now, what becomes really interesting is we have a governmental fintech working group that is looking at how to regulate cryptocurrencies, which has now become terminology defined as crypto assets in South Africa. But as they are trying to regulate the crypto asset, there's a lot more movement that is occurring within the industry. So we actually in a phase of, we need to regulate crypto asset service providers, but as we want to regulate those crypto asset service providers, there's new and more innovative technology which almost takes it a step further, preventing these regulatory bodies from effectively regulating the decentralized platforms that are operating in certain industries. Now, to put it into perspective, in September 2019, DeFi only had about $500 million committed to it. And as of April 2021, there's $50 billion. So in 2017, when the Intergovernmental FinTech Working Group was set up, DeFi platforms weren't necessarily on the radar. And as time has evolved, and as decentralization has continued to develop and protocols have continued to develop, we've now left in a phase where regulators are probably once again looking at how do we effectively regulate these different protocols, one, for example, being Uniswap. And in fact, the key question is, can we regulate? So it's a very good question you ask. I think in respect of the traditional crypto asset service providers who are providing on-ramps and off-ramps, that is something that is possible to regulate. But insofar as decentralized platforms are concerned, this becomes a lot harder to regulate, specifically where there is no specific jurisdiction where they sit.
Ashlin, would you like to add anything to that as well? This is quite a complex area.
Absolutely. And I think that to touch on what Dean's just laid out, the approach is not unique to South Africa. If you look at the FATF, they've also taken the approach of regulating or prescribing regulations for virtual asset service providers, so the VASPs, which essentially are the touch points and on-ramps and off-ramps in respect to the system. And the reason for that is that's where your real world kind of risk bleeds itself into these ecosystems. Now, that's quite important in the context of DeFi. And the reason why is many DeFi systems seek their stability through algorithmic pegging to real world currencies. So in other words, these platforms are not really holding actual currency, rather they're algorithmically using that as a mechanism of stabilizing that value. And that means that there are less on-ramps and off-ramps with real-world actors, and that creates a massive risk in respect of, who do you regulate in the space? What is actually the touch points? Now, why this is important and quite an important issue in DeFi, and probably its defining issue to overcome, is that the liquidity pools that are used to essentially enable DeFi platforms are perfect for money laundering. And that's obviously going to catch the awareness of many regulators, not just in South Africa, but around the world. So I would not be surprised if regulators start looking at ways and means to regulate this. Now, the problem is it is difficult to apply current regulation. As Dean said, for example, it's very difficult to look at your securities regulators and try and find touch points for them to regulate. So the risk to consumers who enter this space and don't understand that it's new, novel, and still being understood is that there's possibly no regulator to look to when something goes wrong. And that's something that DeFi will need to overcome to scale properly.
Thanks so much for that. I mean, given what both of you have said, I think it would be very difficult to be a regulator in financial services, trying to figure out all of this right now and also trying to keep up. I think Dean mentioned as policy decisions were made on, cryptocurrencies as they were, we already have moved along into the new world of NFTs and DeFi, which don't fit as snugly into these definitions that were created for cryptocurrencies. It really is fascinating and as well as mystical. So perhaps that's one thing we can't demystify today.
Perhaps, to use one of the mystical new use cases for DeFi, which I find absolutely fascinating. One novel new use case is called a flash loan. Now, a flash loan is essentially a smart algorithmic loan. So it's a smart contract loan that is not collateralized and where payment is virtually immediate. So if a borrower gets approved for the loan in the real world, typically you'd have to pay back your loan steadily over a period of months or years. A flash loan, however, is immediate. In other words, you get paid back immediately, and that means that the borrower, essentially using smart contracts, can use funds immediately without that intermediate risk. There is no real-world equivalent for this. This doesn't exist in real-world finance and has been exploited, so it's currently got a negative connotation with it, for arbitrage. For example, if you notice between two different exchanges that a specific cryptocurrency is worth $100 on one exchange and $200 on another exchange, you could use one of these flash loans to essentially buy the cryptocurrency on one exchange and exchange with other immediately, and thereby take the difference, the $100 difference between the two as your benefit without any collateral. And that's an example of where DeFi can actually be exploited, or potentially, if this is done properly, used in a way to create things that don't even exist in the real world and for which we have no context for regulation.
Sure. And I mean, things like loans in the traditional sense, do come with heavy regulation and licenses and things like that. And these, I guess, are performing very similar services, but largely unregulated, given the way they are set up. It is really fascinating stuff. Dean, I mean, we've spoken about one application now of DeFi, but could you perhaps share some other examples of DeFi applications that you've come across?
Absolutely. So to touch on what we've already discussed, we've already mentioned decentralized exchanges, which help users exchange cryptocurrencies for other currencies. And this could either be US dollars for Bitcoin or for Ethereum, or Ethereum to Bitcoin, and all the different trading pairs. And decentralized exchanges are currently becoming a lot more hyped up than centralized exchanges, due to the fact that it connects users directly, so they can trade cryptocurrencies with one another without trusting an intermediary with their money. So that's the first popular use case. Another is stable coins, which Ashlin had mentioned. And this is in essence a cryptocurrency that is tied to an asset outside of the cryptocurrency market. And this is to stabilize price. And a key example is TrueUSD or Tether, where there is a pretty much one-to-one backed cryptocurrency. The other example is lending platforms, which are platforms that use smart contracts to replace intermediaries, such as banks that manage the lending in the middle. Another example is what is considered wrapped Bitcoins, which is a way of sending Bitcoin to the Ethereum network. So the Bitcoin can be used directly in Ethereum's DeFi system, and wrapped Bitcoins allow users to earn interest on the Bitcoin they lend out via decentralized lending platforms. And then you have various other things such as prediction markets, which is markets for betting on the outcome of future events. And a key example of this would be the election. But where it gets slightly more complex is where you have DeFi concepts such as yield farming, liquidity mining, money Legos, which Ashlin briefly touched on, and those. And just to give you a high level summary, yield farming is for knowledgeable traders who are willing to take a risk, where they can scan through various DeFi tokens in search of opportunities for larger returns. Liquidity mining is when the DeFi applications entice users to their platform by giving them free tokens. And then money Legos is putting the concept or putting DeFi apps like Legos, where you can, in essence, build and construct different platforms together. So those are various different use cases of DeFi.
Thanks so much for that breakdown. And I mean, given that it's such a new area of development, there is really quite a lot of activity and a number of different types of use cases and applications already, out there. And I assume a lot of users already, making use of these decentralized finance opportunities, given that we have so many options out there. Ashlin, what are the risks to these users? Given that we've already discussed, it's difficult, near impossible to actually regulate these platforms. Whereas in the traditional sense, the financial services is one of our most highly regulated industries. What are the risks to people now that are engaging and using these services?
I think one of the major things to bear in mind is this entire area is very nascent and attack prone. In other words, most platforms are still being developed. The technologists behind them are still investigating how to do this in a safe way. And we haven't really seen all of the sort of harms that could occur happen as yet, where mitigation measures can be developed. So anyone entering this area must bear in mind that it's new, it's developing, it is developing in the public eye, in the sense that this is not happening in some R&D center where we can't see what's happening. And it's even, I would say, before early adopter stage. This is something that still needs some work. In addition to that, there's the risk of immutable deployment of smart contracts. Because of the way in which smart contracts work on a protocol, it's very difficult unless you build it into the system to reverse changes. And this creates smart contract vulnerability to glitches or even intentional harm by bad actors. That's something very important to take into account. The second is that the general view is that these are unregulated to some extent. They don't really fall into security regulations, and it's difficult to classify a decentralized organization as a bank. So it's difficult to understand what kind of regulatory recourse there would be to a consumer if, for example, a smart contract malfunctioned and created a risk for the entire ecosystem. There's also the recursive lending problem. So this is basically where the Lego blocks that Dean was talking about and we mentioned earlier are used to create complex lending platforms where you can essentially create value on top of value on top of value. And we only have to go back to 2008 to realize the problem with that. And that's compounded if you don't have some sort of method of oversight or audit in respect of a decentralized platform. In my mind, I also think that standardization for the average consumer is a risk. We've spoken a lot about MakerDAO, and there's a couple of other platforms, but if you have to compare them as an expert, it's difficult. So it makes it even more challenging for a consumer to choose between products because of complex systems, complex marketing profiles, and the like. And then lastly, there's the big disregard at the moment that we're noticing in respect of know your customer and anti-money laundering procedures. As we mentioned, liquidity pools are perfect for money laundering, and that creates wider public risk that still needs to be addressed. So there are a couple of areas where essentially DeFi has a shopping list of issues to work out before it can really be safe for public consumption.
Dean, I mean, we've discussed a lot of the good stuff that's coming with DeFi, but can you highlight any of the criticisms of DeFi that you've come across?
Absolutely. So I think the three most relevant ones, which we've briefly touched on tonight, are, the first being the fact that the transactions are irreversible. So which means that if there's an incorrect transaction with the DeFi platform, or even deployment of a smart contract code containing errors, there's a risk that this cannot be easily corrected, and therefore the transaction will be irreversible, resulting in someone having some form of financial loss in the chain. The second is the fact that there could be coding errors, hacks, and this is pretty common. And you just got to look back in 2020, where one of the platforms known as Yam Finance quickly grew its deposits to $750 million before crashing days after its launch due to a code error. So that still remains quite a key issue. And the third is definitely in relation to the Know Your Customer and anti-money laundering rules. Now, while these platforms try to regulate these in some sense, this is only normally done by centralized platforms. And where there's decentralized platforms involved, you normally find that they could be used for some form of anti-money laundering during that process.
Do you guys believe the lack of know your customer or anti-money laundering compliance will be a showstopper for DeFi, or do you believe that it will continue regardless of having this type of regulation?
In my view, it's really too early to tell. I feel like it could be a showstopper if it's left undealt with by many of these platforms, which for some does seem to be the trend. So I do feel that if they do not take that as a serious issue to solve, I think that could be a regulatory death knell for DeFi as a widespread platform, a widespread phenomenon. But if it is taken seriously and if these problems are worked on, I think there are numerous benefits for DeFi to exist and even coexist with centralized finance or CeFi.
Could you elaborate on some of those benefits?
Well, we spoke a little bit about the centralized risk and the benefit of having decentralized systems. I mean, for example, the people governance has for many years, and especially in our financial crisis in 2008, shown the massive human error and human malicious features of the financial system. So the risk of manipulation is something that is obviously possibly dealt with by DeFi. However, in addition to that, there's also accessibility. So DeFi has the potential to allow financial services to be accessible by the underbanked and the unbanked, those who do not have access to current financial ecosystems. Now, that potential is still theoretical. The barriers to financial inclusion go beyond the solutions of a new technical system for financial services. And there are other barriers that obviously exist to financial inclusion, but that's one of the promises that DeFi brings. One other interesting promise, and this is one that I find quite unique to DeFi, is the use of fee tokens. So, for example, a MakerDAO has the ability to have fee tokens, and these essentially are tokens that are used to reward persons who have committed their cryptocurrency to a DeFi platform. Now, those fee tokens function as a form of rental against your cryptocurrency or against whatever commitment you've made within that DeFi platform. And that's a big step forward in respect of the cryptocurrency world entirely, because if you think about how Bitcoin and other cryptocurrencies work, the value that's associated with them is not intrinsic, it's rather speculative value. Bitcoin, for example, has a limited pool of available Bitcoin, and that's what creates its scarcity value and then speculation, and then that is built on that scarcity. However, with fee tokens, what you create is the potential of cash flows associated with cryptocurrencies. And the great thing about cash flows is you can use models like discounted cash flow valuations to establish value. And that means a much, much more intrinsic valuation could be done of certain systems or certain cryptocurrencies than was previously even thought of.
Dean, just following on from something that Ashlin said, he spoke about financial inclusion as one of the potential benefits of DeFi. Could you perhaps apply that to the continent, to the South African context, to the African context, and explain to us, will there be adoption in Africa of DeFi?
Absolutely. So I think we got to take it back and look at the fact that a large part of the African adult population remains unbanked. And the continent has about 298 million adults with bank accounts. And this is according to Statista in 2017. But by 2022, the number of banked adults will only rise to 456 million, or roughly 38% of the continent's population. So what this in essence means is that a large portion of the population still remains unbanked. So Africa's need for financial inclusion is rising, especially amongst its young population. So banking is vital, and for poverty reduction and sustainable growth, we need to look at ways on how we can improve the traditional banking system, which in essence has failed to bridge the gap. So mobile money and open banking platforms have quickly taken over most banking roles, but they haven't necessarily fulfilled these roles. So the two financial sectors that have leveraged mobile phone technology and data to build efficient domestic payments and financial systems have been looked at, and where we introduce decentralized finance platforms to the continent's youthful population, what we could potentially do is leapfrog the region's financial development and create a new way of helping the unbanked become banked. So, in my view, Africa's major banking challenge is its existing inferiority in relation to the banking system. And because the infrastructure as a whole is poor and financial education lacks in many of the countries, banks have been trying to reach the unbanked, and I don't necessarily think they've actually developed this. So most of the population who has low income is often the part of the population that remains unbanked. So decentralized finance can actually avail freedom to consumers by eliminating the need for banking institutions altogether and actually providing direct access to participants in Africa to ultimately interact in a financial system that is one that may be seen as parallel to the centralized financial system. And we've seen the fact that Facebook and Google have tried to lead the race of rural internet access. And I think as they continue to do that, what we will see is opportunities for DeFi to widen, particularly in the African context. And this may in turn result in a lot more of the younger population having access to the financial system. And hopefully in turn, the 38% of the African continent that is currently banked will rise to a much higher portion, even if it's in a decentralized format.
I think that is truly motivational, and I do hope everything you said does come to fruition. And I think what you touched on towards the end there is vitally important. Having DeFi is all well and good, but if we don't have access to the basics such as internet access and access to affordable data, then you also excluded from this new realm of financial services. So I think what you said with regards to Facebook and Google trying to supply these services, to too many rural parts who didn't have it before, that coupled with the rise of DeFi challenging the traditional financial services which have failed to bridge the gap, we could really see something remarkable on the continent, and I'll be really excited to watch that journey. For our listeners, for people who want to actually learn more, could you also just tell us now in what are some of the use cases that we're seeing are the most popular, and also perhaps a few platforms that people can go and check out and go and actually see, DeFi in action. What does it look like? What are these platforms doing? And perhaps try and engage with this new way of doing finance.
I think firstly we must say that whatever we say is in no way a backing or advice to look at any of these specific platforms, but I think one can look at various DeFi tokens that are currently floating in the market, and some examples of those include Uniswap, Chainlink, RV, Terra Luna, PancakeSwap, and all these different crypto asset tokens. And we just have to touch on it briefly to get educated, but in essence, like as we mentioned earlier, Uniswap is a decentralized trading protocol, and it's known for its role in facilitating automated trading of decentralized finance tokens. Similarly, we have Chainlink, which is a decentralized network which aims to connect smart contracts with data from the real world. And there are a whole host of other different platforms. And what I would say to people is what they should do is do their own research online, get a bit more understanding. And a good starting point is to probably go on a site such as coinmarketcap.com and view the DeFi tokens. You can click on the various tokens and start to learn a lot more about each respective token. And in a similar context, you can also have a look online at what DeFi means and what it's doing for the market in order to understand it. And to touch on, some popular use cases, there are the platforms such as Nexo, BlockFi, Celsius, which are all looking at ways for consumers to stake their cryptocurrencies, to earn interest. But, consumers must be aware of the risks, as these are quite significant. So once again, I think the most important step would be to educate yourself before making any decisions. And some of the projects you can look at are the ones I mentioned.
Thanks so much for that. Ashlin, anything to add in terms of where people can go look after listening to this conversation for more information, or to really go and see some practical examples?
Thanks, Nerushka. There's quite a variety of articles out there. CoinDesk has a couple that are really, really good and worthwhile reading. Again, it's difficult to choose a particular platform with information that's great. And the truth when it comes to DeFi is it's such a quickly evolving space that it sometimes means going directly to the source to get your information. So, for example, going through the particular platforms. Just to answer the question on what kind of things to think about, the Lego ability of DeFi is also important to think about. With a lot of the services you could build yourself, you will be, for example, if you were going to create your own package of services, doing so using different platforms. For example, if you're going to do enter the system itself, you might use MakerDAO. If you're going to borrow, you may use Aave or Compound. These are just examples, but those are borrowing platforms. If you're going to insure, you could use Nexus Mutual. All of these are examples of different platforms that do different things in very, very different ways. And therefore, it's important to understand that it's not a uniform space. It's not like there is one way in which this operates. There is really a zoo of options. And therefore, I would encourage, just as Dean has done, anyone entering the space to do their homework, to make sure that they understand the differences and really do not sort of invest in these sort of things without getting that education, right?
Sure. Thanks so much. So we're coming to the end of our conversation. Before we close, to our live listeners in the room, if there's anybody who would like to make a comment or ask a question, if you could just indicate that now. And if not, we'll go straight to closing comments. Okay, I think we'll head off straight into closing comments. So, Dean, we'll start with you. Really, anything with regards to the future of DeFi, where you see this headed, given the broader cryptocurrency landscape, and any other closing comments you'd like to leave for our listeners.
I think one thing to say is that, today was quite an interesting day in cryptocurrencies as a whole, where the market cap exceeded $2 trillion, and the DeFi market cap is only sitting at about $90 billion at the moment. And the total value locked into DeFi as of April is only about $50 billion. So I think we're still at a very, very early stage. I think there is a lot of education that needs to take place, and along the way, there are going to be a lot of mistakes, but a lot of good, innovative technology solutions that will be built. So yeah, I guess my only comment for listeners is to continue educating yourself, do your own research, and continue understanding concepts and what this actually means for the financial system of the future.
Thanks so much. And Ashlin?
I echo everything that Dean has raised, so it's a little to add to the fact that education is extremely important. One thing I will say in respect of the DeFi space, that there is still a gap between the theory and the practical implementation and execution, and that gap needs to be closed significantly before this is ready for wider rollouts. So I think it is important when reading about these things to understand the theory, but also understand the practical execution and whether the execution achieves the promise. But nonetheless, there are new and novel things that are emerging from DeFi that I'm quite excited about. So it's really exciting to continue to read in this space and see what these new products and new features could be that we haven't seen before.
Thank you so much for that. We've come to the end of our conversation on demystifying DeFi. This will be up on our podcast soon, Vault Law Tech. You can find it on your favorite podcast channel. We already have our first podcast up about propelling Africa through NFTs. And follow us on Twitter, VaultLaw_tech, to see what our next events are coming up. We will be having conversations like these on a regular basis. Thank you for listening. Goodbye.
Thanks for tuning in to this week's Vault podcast. As a reminder, all views expressed are those of the speakers and are not meant to be of any organization or be treated as legal or financial advice. We hope you have enjoyed this program. To receive updates of upcoming events, please follow us on our Twitter handle @VaultLaw_tech or subscribe to our newsletter by visiting our website www.vaultlaw.tech. Until next time.